99% of ICT traders fail, and I'm going to show you guys the number one reason why that statistic is the way it is. If you look at the schematic on the screen right now, this is what 99% of ICT traders are looking for. They're looking for a market structure shift after a run on liquidity with a fair value gap. Let's say that this is on the 5-minute time frame. If you were going into price action just looking for this, you have it all wrong. And the reason is because you need to understand where price is drawing towards on a higher time frame, and then you could look for this signature in price action. A market structure shift with a fair value gap after a run on liquidity is not a model with a high probability win rate. Sure, you could trade this and it may deliver 20-30% of the time, but if you were just strictly looking for this in price action, there is a 99% chance you're going to fail. Okay, and the reason that is because let's say that this is a 4-hour time frame. Okay, this is a higher time frame market maker sell model. If you don't know what a market maker sell model is, this is what it looks like in a schematic. I'll move my mouse so you guys can screenshot this if you'd like. This is the ICT market maker sell model. This is the ICT market maker buy model. Okay, let's say that this 4-hour is in a market maker sell model. The target is the original consolidation. So let's say that this is a 4-hour chart. Price is drawing towards the original consolidation. That is where price targets in a market maker sell model because it moves from the original consolidation to an accumulation. There could be 1 or 2 legs of accumulation in here. Then you get a smart money reversal at a key level. Okay, the low risk sell will be up in here, and then you'll get a first leg distribution and then a second leg redistribution before it targets the original consolidation. So a big problem ICT traders have is a lack of higher time frame bias or narrative, because if a higher time frame is heading for a key level, the lower time frame is subordinate to that higher time frame. You cannot just go onto a chart and hop onto a 15-minute time frame or 5-minute and look for this signature in price action at levels of liquidity. You could do that, but it's going to be a lower win rate. Okay, when I go into price action, I do a top-down analysis from the weekly, and I try and figure out where the higher time frame is drawing towards. Okay, there's going to be more liquidity on higher time frame charts as banks are using levels like the daily for levels of liquidity, right? So if the daily is heading for a key level, or if the 12-hour or 4-hour time frame is heading for a key level, the 5-minute structure is going to be subordinate to that higher time frame narrative, which would be if the daily, or let's say 4-hour in this example, if the 4-hour is heading for this key level right here, or this key level, we have 2 lows right in here. If the 4-hour is heading for that, along the way, you will get these 5-minute market structure shifts with fair value gaps. Picture this. If price is bearish and a 4-hour is heading for this key low right in here, let's say it's heading for this orange level. If this orange level is the draw on liquidity because we have these 2 lows in here, even if the 4-hour is bearish, you're still going to see this model in a 4-hour market maker sell model. So to put it simply, if price is going to be bearish and drop down to these levels of liquidity right here, you're still going to see this signature along the way down because price just doesn't drop down like this. Okay, you're still going to get the lower lows, lower highs, right? So if you're going to get that, you're still going to get the signature. So whether the higher time frame bias is bearish or bullish, you're going to get this signature in price action. That's why this by itself should not be an entry model. You should not just, this by itself shouldn't be an entry strategy, right? You should not just be looking for this in price action. You need a higher time frame narrative. You need to know where price is drawing towards. Then this can be high probability. That is what ICT was trying to point towards in the 2022 mentorship, but 99% of people just think he's talking about this. Okay, this is not what he's telling you to enter solely based on. He's trying to tell you, look at a higher time frame chart, which level of liquidity is being targeted, and then you can incorporate this entry model. So the next question is, well, how do you figure out a higher time frame bias? We're going to touch on that in a second. Okay, so we're going to identify that this 4-hour is going to be the target. Why? Because we have a market maker sell model here. All right, so you have the original consolidation. Okay, so this is where the market is likely targeting because we have an original consolidation. All right, price moved away from that original consolidation. Okay, we had some accumulation. Smart money reversal is up here. Okay, and then price is displacing beneath this previous low. Okay, so it displaces beneath it. Okay, you like to see candle closes beneath old lows. Okay, wicks do the damage, bodies tell the story, so I'm paying attention to candlesticks along the way down. If we get a close beneath this low with displacement, okay, it's likely to head for the next one. If you guys would like to see more content from me, I do have a Discord server where I do share my thoughts on the market real time. I don't do live streams, but I am giving my opinion on where I believe price is heading. Usually on the NASDAQ and the S&P 500, I do cover other markets as well. Here was a setup from today. I did take an L earlier before this, but this was the most recent one where I was saying we were in a market maker sell model. Price is likely to draw into these lows. Typically, I am giving out the bias of where price is heading. It's not a signal service, okay? But if you understand the logic, once you have the draw on liquidity, it becomes easy to enter into those moves. I also have a 8-video course explaining how to trade ICT concepts from beginner to advanced. Also a library of 30+ videos uncovering ICT gems. If you guys are interested in that, there is a 3-day free trial link down below. Okay, Dan, so I know that I shouldn't just be looking for this signature and price action, but how do I fix that? That's what we're going to be talking about right now. We're actually going to take a look at a live chart example. The way you fix it is by having a higher time frame bias, identifying where price is drawing towards on a higher time frame, such as a 4-hour, such as a daily. Okay, your higher time frame bias doesn't have to be a weekly or a daily. Your higher time frame can be a 4-hour. If it's not drawing towards anywhere on a daily or a weekly, start on a 12-hour, start on a 4-hour time frame. Okay, so we're going to take a look at a live example. Now this retracement was only retracing to this fair value gap. Now, why this specific fair value gap? Because if we do draw a fib from this swing low, why this swing low? Well, because this started the displacement higher. Okay, and we draw our premium and discount. All right, all price did from this high to this low is reprice down to a discount fair value gap in here. So once price taps into the discount fair value gap, which was the draw on liquidity, price was drawing towards this specific low right here. Okay, once it draws into that, this is where a new setup can potentially form because it already repriced from liquidity up here. It took out buy side liquidity. What does ICT talk about? It's repricing from liquidity that's external to liquidity that's internal. What is internal range liquidity in this example? A fair value gap. So this is going to be our higher time frame key level. All right, so it takes out that liquidity. That was the draw. And then price expands higher, expands out of that. So if we look at a 4-hour time frame, notice how it wicks that 1-hour fair value gap. Okay, on the 1-hour time frame, price expands out of there. Okay, and then it creates a change in the state delivery. Okay, so the draw on liquidity now is for price to move from this internal range to this external range. Okay, but we get a close over this order block. So this may sound confusing, but I'm going to completely clear things up. In this example, I'm using the 1-hour as my higher time frame bias. Why? Because I don't see anything yet in here on a daily time frame. Okay, so if I'm just looking at a daily, okay, we did take out this previous day's low. That's the only thing that I would look at on a daily time frame. All right, but on the hourly, it becomes the clearest because we do have this large down close candle that pierced into this discount fair value gap. So discount FVG, that's key. This is our key level. And price closes above this one down close candle while creating a fair value gap to the upside. Okay, so what is this going to indicate? Well, price took out liquidity. Okay, so you could still use that entry technique, but you need to identify liquidity where it's heading to on a higher time frame and then apply this logic onto a lower time frame aligned with that higher time frame order flow. So I'm going to explain what that means now. We have a key level, a discount fair value gap. It's a fair value gap below 50% of the range. So if I draw this fib again, notice how this fair value gap is fully in a discount. Okay, that makes it a fair value gap that's a key level in here. Okay, so if we look at a 30-minute time frame, there may be a fair value gap that is overlapping a premium and discount. That doesn't matter as much to me. Right? I want to see a FVG fully in a discount. That's what ICT talks about in the 2022 mentorship. Okay, when price closes above this order block, it indicates a change in the state delivery, meaning price is going to want to attack buy side liquidity. This is what ICT talks about in the 2022 mentorship. What is buy side liquidity? We're looking for old swing highs that are obvious. Okay, if we mark all of those out, which I'm going to do now, we have this high, this high, this high, and this high. These are the obvious levels of liquidity that price is now going to target because It tapped into a key level, which is the discount fair value gap. It created an order block. Why? This down close candle took out liquidity and price closed above it. Since it closed above the order block, and it also has fair value gaps in this price like higher, will be an example of a fair value gap, something like this. Okay. It's now going to target buy side liquidity. So my higher time frame bias, as soon as price closes above this order block, my higher time frame bias is going to be 5,300, 5,306, 5,311, and 5,322. So I'm only going to be looking for setups in the direction of this higher time frame bias. So we have a few steps that we need to tackle. Step 1, frame a higher time frame bias. Okay, what's my higher time frame bias in this scenario? Well, 1 hour is bullish. So what do we do next? Well, now we can look for this lower time frame model. So the lower time frame model by itself is not enough for an entry technique, but what you can do for the highest probability setups is frame a higher time frame bias. Where is price drawing towards? It's drawing towards buy side liquidity. Since I have that overall direction, I can look for this at key levels. Okay, so what will be a key level? In this example, we already believe price is going to draw up into these highs above. Okay, so now on a lower time frame, let's go down to a 15-minute. I can mark out levels of liquidity. So we do have this previous low over here. Okay, this is a discount PD array. Okay, highs and lows are PD arrays. Okay, out of these levels, we can look for a change in the state delivery. We could look for a breaker. We could also turtle soup it. So there's 3 entry techniques where I can get into the market now. I could turtle soup these lows. What about this low, Dan? First of all, it's too close to this high. And second of all, we displaced right through it. Okay, wicks do the damage, bodies tell the story. Notice how price starts to wick at this level. It's getting slow to the downside. At this low, we just see speed through it. So I'm paying attention to the candle closes. I'm paying attention to the wicks, and I'm seeing where price is sensitive to. Okay, so this order block down in here, price is referring to the wick to the open. So this is a bullish order block. Okay, this is going to be the key level that price is bouncing off of. Okay, when you see a large upper wick on an order block, you use the open to the wick as the key level to extend out. So there's a few different ways I can get into this move now. We have our higher time frame bias. I could turtle soup these lows, meaning I could buy external range liquidity. So when this low gets triggered, retail traders are selling. They're getting stopped out of their longs. Smart money is buying from those sellers. Okay, we're not going to be diving too deep into that. The entry technique that I am going to be teaching here is the breaker though. Okay, so notice how we have a low, high, lower low, higher high. So this up close candle in here is going to be the breaker. Okay, so now that we have the higher time frame bias, we could enter on a breaker at a key level, or we could enter on an order block at a key level aligned with that higher time frame bias. You guys should watch this video 2-3 times because I'm literally giving it to you here. Okay, this is the most high probability model that you could find. Why is this not the breaker, Dan? This looks like the breaker to me. Some of you guys may be saying that right now. This one's a little bit higher than that down close candle. Notice how this is a low, high, and then this is a higher low. That makes this up close candle a mitigation block. So you could enter on that too. Similar logic. It's just that a breaker makes a low. Okay, we make the low, high, lower low. That's the difference. The mitigation block doesn't make the lower low. Okay, so you could enter when price returns back into this breaker. All right, as soon as it does that, okay, your stop could be beneath candle number 2 with the fair value gap right here, or beneath here. Okay, and where am I going to be targeting now? Well, I could target this previous high, which puts you at about a 3R trade, or I could hold for the higher time frame bias target, which puts you at about a 7R trade. Okay, so what's step 2? Step 2 is to identify a key level. Okay, so we frame the higher time frame bias. Step 2 is identify the key level. Step 3, okay, wait for an entry model. Okay, so what's the key level here? It's the discount lows. So we have these old lows that are obvious. If the draw on liquidity is higher, price will refer to these lows. Okay, once it hits the key level, you wait for an entry model. You could turtle soup it if you're confident, or you could wait for a breaker to form, which we have right here, which is waiting for a close above the breaker. Okay, or I could wait for price to close above an order block, which you could enter on right there when price returns into it or when it fully closes above it. So I have 3 ways to enter there. Okay, so I'm entering in off of a 15-minute model, but then I'm using a higher time frame target to target, or I could just target the lower time frame target. This is going to be the first level to partial out at. Okay, so you could take profit at this high right here and then potentially leave runners for higher up, or I could just target this high right here. Okay, so it's extremely simple. We're framing a higher time frame bias. That was step 1. Step 2 is identify a key level. We have these old lows right in here. Step 3, wait for an entry model. Okay, and pay attention to the wicks and bodies of the candles. Okay, that's going to be it for this video. It's extremely simple. There's 3 steps to it. You're not just going in and waiting for an entry model. This is what 99% of ICT traders do. Okay, if you want to be in the majority, continue to do this. But if you don't want to be in the majority, make sure you wait for these 3 steps to enter. You're not just waiting for the entry model. You're not just using a higher time frame bias. You're using all 3 of these combined. That's going to be it for this video. If you guys enjoyed this, please share, like, and subscribe, and I will continue to make videos like this. See you guys later.